Welcome! Today we're diving into Royal Unibrew, a company that's in the middle of a really high-stakes transformation. They're basically trading a sure thing, a safe, profitable business, for a shot at some serious high-speed growth. So let's kick things off with a big question. What if a company doubled its size, but in the process actually became less profitable? I mean, really think about that for a second. Because that question, that's the absolute heart of the investment story for this Danish beverage company. All right, so how on earth did we get here? Well, first, we've got to understand how Royal Unibrew has been deliberately, and I mean aggressively, changing its entire identity through a massive shopping spree of acquisitions. This slide just lays it out perfectly, doesn't it? It's like a before and after picture. On the left, you've got the old Royal Unibrew, super safe, super profitable, mostly focused on the Nordic countries. And on the right, the new Unibrew, a huge pan-European player. But, and this is the key, look at those profit margins and returns. They've tanked. The company literally chose to get bigger at the expense of being more profitable. And the result of that choice is pretty wild. Royal Unibrew isn't really just a brewer anymore. Would you believe it? Non-alcoholic drinks are now the majority of their sales. For a company with brew right there in the name, that is a fundamental shift in who they are. So why in the world would they do this? Why make such a drastic change? And that brings us to the bull case, the optimistic side of the story. Let's dig into why some investors are really excited and think this high-risk bet is going to pay off in a big way. The entire strategy really boils down to this one super simple chart. The traditional beer and alcohol market, it's basically flat, almost no growth. But the non-alcoholic space, whoa, it's set to grow more than 5 times faster. So what did Royal Unibrew do? They pointed their entire ship right at that fast-growing market. So the bulls, the optimists out there, they believe the company is perfectly positioned. They've got the right brands in the fastest-growing spots, think energy drinks and no alcohol options. They see a company that has this proven system for buying other businesses and plugging them in, all while turning out enough cash to handle its debt. The bet is that their strong, local hero brands can become even bigger heroes all across Europe. And here's the vision, straight from management. Their goal isn't just to sell more soda, it's to become the preferred choice. They want to be so essential to local bars, restaurants, and supermarkets that those places can't imagine operating without them. They're aiming to be indispensable. Okay, but you know as well as I do that every big bet comes with big risks. So now, let's flip the coin and look at the bear case. The argument from the skeptics who think this whole transformation could seriously backfire. The first major risk is actually pretty simple, the price tag. As an investor, you're paying a premium for Royal Unibrew stock right now. This number, what's called a valuation multiple, tells us that really high expectations for the future are already baked into the stock price. There is just very, very little room for error. And when you put it right next to its giant competitors, you can really see that premium. You're paying a lot more for a piece of Royal Unibrew than you are for giants like Carlsberg or Heineken. Now, what does that mean? It means if their big growth story stumbles even a tiny bit, the stock could fall hard just to get back in line with everyone else. For the bears, it all comes down to one simple word: execution. They're worried the company has bitten off more than it can chew. I mean, can they really absorb these massive new businesses smoothly? Can they actually compete against global giants like Coke and Pepsi in brand new markets? The big fear is that any misstep, any little slip-up, could cause that fancy valuation to just collapse. Okay, we've heard both sides of the argument, the bulls and the bears. So now let's stop guessing and look at the hard data. Let's see how this tug-of-war is actually playing out in the company's financial reports. This one little table tells you the entire story in just 3 lines. Look at that net revenue. It's more than doubled. It's exploded. But then your eyes go to the next 2 rows. The profit margin and this other metric, ROIC, well, they've basically fallen off a cliff. First, here is the bull case in a single, beautiful number. Revenue has grown over 100% in just 5 years. That is undeniable, pedal to the metal growth. It's exactly what management said they would do. But, and it's a huge but, here is the bill for all that growth. The company's core profitability has been squeezed, and squeezed hard. They bought faster-growing companies, sure, but those companies were just less profitable, and it's dragged the whole company's average way down. Now, to really get this from an investor's point of view, we have to talk about something called ROIC, or return on invested capital. Just think of it like the company's report card. It tells you exactly how good they are at taking a dollar of your money and turning it into more money.
And that report card grade, well, it's dropped. It's gone from a stellar 20%, a real A+, down to just 12%, maybe a B-. This shows us that the new, bigger company is just way less efficient at making a profit from the money it invests. So for us as investors, the multi-billion-dollar question is, can they get that grade back up? So what's going to win out in the end? The explosive growth or the falling profits? Well, the good news is you don't have to guess. Here are the exact numbers you can watch to see which story, the bull or the bear, is actually winning. Think of this as your investor watch list. 4 key things to check in their quarterly reports. First, is the underlying business growing on its own without more acquisitions? Second, are they actually starting to make more money in their new markets, like France and Italy? Third, is that all-important report card, the ROIC, starting to improve? And finally, are they managing their debt responsibly? And guess what? We don't have to wait long for the next chapter of this story. Their next big report comes out in August. It's going to cover the super important summer season, and it'll give us our first real data points on whether the bulls or the bears are winning this fight. And at the end of the day, that's really the question, isn't it? Is this a growth champion that's just getting started, or is it a company suffering from a really bad case of expensive indigestion? Now you know exactly what to watch to find out for yourself.